Hello, John. It's Bruce Youngblud at PensionSolutionsCanada.com, and I'm happy today to be with Jon Hreljac, who is Manulife Tax and Estate Planning Team. How are you today, John?
Hey, good morning, Bruce. I'm great, thank you. Thanks for having me on your call today.
My pleasure. Our pleasure. So we're talking to business owners specifically today, and we're going to talk about three subjects. One is the best way to take money out of your investment gains from your corporation. Second is actually we have a fund that doesn't pay out very much every year and why that's a good idea. And then we'll wrap it up with annuities.
So, Bruce, the first thing I always like to comment on, because this is a question I often get from advisors, clients themselves, business owners who are incorporated, is how to take money out of a corporation tax efficiently or even better tax-free. And really there's different means of doing it. But really, when we're looking at the investment side of the business, what you need to really hone on is what I say the best type of income to generate inside of a corporation from a investment perspective. And this is not very widely known. And what this screen and what this slide is showing is that if you are investing through your corporation, and many incorporated business owners do, they typically will have excess, retained earnings or cash that is generated from their active income, and now they have extra income to invest with. And I always tell clients as well that unless you can get your money out tax-free or tax efficiently inside of your corporation, to the extent you don't need that cash personally to fund your lifestyle, or maybe to do some investments personally, you're going to be better off to leave that money inside your corporation to invest with. Because over the course of time, from a compounding perspective, you're going to have more, nests, more of a nest egg to grow. Because again, typically it's expensive to get it out if you're in a high marginal rate personally. So what this slide is showing, it's one of the favorite slides I utilize for all the presentations I do, is the way I explain it is that if I'm investing inside my corporation and if I can wave a magic wand and pick the best type of income to earn inside of my corporation, what would be the best type of income? And from left to right, what we have here is capital gains, Canadian dividends, return of capital, interest income, and foreign dividends. And you can see from left to right, if you look at the bottom bolded tax rates, and this is the combined corporate marginal shareholder tax rate, how much more favorable capital gains are compared to, say, interest income or foreign dividends on the far right. And the reason that is the ability inside of a corporation to generate tax-deferred growth and ultimately crystallize and realize capital gains and take advantage of something called the capital dividend account. Okay. I think a lot of people realize, Bruce, is that when you realize a capital gain personally, half is taxed and half is tax-free. The same thing happens inside of a corporation. Half is taxed and half is tax-free. The tax-free portion is added to the capital dividend account. So in this case, $50,000, and that can be paid out to the shareholder tax-free by electing to pay a capital dividend. So capital gains are definitely the most tax-efficient type of income to earn inside of a corporation. Canadian dividends in the second column, better than the others, but not great. Canadian dividends are a little bit more tax efficient if you're a lower marginal rate personally to get that out. This is assuming that the shareholder here is in the highest marginal tax rate personally. Another thing I'll stress is that as an investor inside of your corporation, you really want to stray away from interest income and foreign dividends. They're very tax punitive, both inside the corporation and once you try to get it out of the corp. As you can see, earning foreign dividends inside of a corporation. When I say foreign dividends, that basically means investing, say, in a U.S. dividend payer directly. By the time that dividend is flushed through out of the corporation into the shareholders' pockets, you're paying nearly 64.15% tax on that dividend. So hone in on capital gains and stray away from interest and foreign dividends.
So it doesn't pay out much annually. John, why is that a good thing for a corporation owner?
Yeah, absolutely. So I think what a lot of investors perhaps, realize or don't realize is that depending on the underlying, say, fund you're invested in, at the end of the year, that fund will allocate income or capital gains depending on how the fund performed over the course of that particular year. And typically, investors really don't like allocations or distributions at the end of the year because you're forced to pay tax on that allocation or distribution, regardless of how the fund actually performs. So a fund like Manulife Global Equity Private Segregated Pool, if you look at the history of their allocations, they are quite low compared to other mandates, right? So in order to, minimize, the reportable income inside of a corporation or even personally, what you can do is look at the historical allocations of a particular fund. And typically it can be indicative of what the future allocations may be. And if they're low, it's a great investment option because what you're effectively doing is, avoiding paying tax or prepaying tax on these allocations now, versus other funds that may have a history of high allocations. So it's definitely a strategy to consider when investing inside of a fund, looking at their allocations over the course of time and honing in on a fund with minimal allocations. And if they do have allocations, again, stray away from interest or foreign income allocations and perhaps only focusing on funds that have minimal capital gain allocations or Canadian dividend allocations, which will be also more tax efficient.
Thanks, John. Isn't that ironic? Here we are as investors always looking for maximum payout, but here's an instance where it's more tax efficient to not be paid out, let everything accrue. Let's keep moving. And the final item that we want to talk about today are annuities. And I'm going to kick this off just to say, get them while they're hot. Rates are higher than they have been in recent memory, and more importantly, expected to decline over 2024. I'm not here to predict interest rates, but it's a teeter-totter. So as rates go down, your annuity payments go down. So here's the thing. As I say, rates are high. Get them while they're hot. Good time to buy an annuity. We can actually issue annuities that will pay you 10%. Now, it's not magic. It means that you invest the money with us through Manulife, and we'll sit on it for a number of years. So if you're 59, you're going to retire at 65, you say to me, what kind of percent can I get? Well, we'll do the math, and I can get you 10% return. So it'll pay you 10% a year for the rest of your life. And that's the key, is it pays you forever. Anything to add to that, John? And we'll wrap it up.
Yeah, no, I guess another point I'll add is from a taxation perspective, when it comes to annuities, I'm often asked, or clients inquire, what are the options? And really, when it comes to annuities from a non-reg personally held perspective, you can look at either what they call a prescribed annuity, which allows for a level taxation over the course of that annuity, meaning the income reported is going to be level over the course of time, versus a non-prescribed annuity, where more income is reported upfront and there's a declining balance over the course of time. So typically investors like the prescribed option because they have that level taxation, and it does allow for a deferral opportunity in the earlier years as you're reporting less income upfront versus the non-prescribed option. So that's just food for thought when looking at annuity quotes and thinking about what type of annuity one will be looking at. The income and taxation aspect, always comes into play.
Great. Thanks, John. Let's wrap it up then. Thanks for watching. Business owners, corporation owners, here's some tax ideas for you. And if you'd like to access them or talk more, get a hold of me and I'll bring John on board and we can have a look at you and your situation. I'm Bruce Youngblud at pensionsolutionscanada.com, and I want to thank Jon Hreljac, Manulife Tax and Estate Planning Team. Thanks very much, John.
Thank you.
See you soon. Thank you. Good day.